Hi, welcome to Investment Analysis and Portfolio Management course. The title of this module is Markowitz Optimal Risky Portfolios. The section goal is to understand the portfolio theory and asset pricing models. And the module goal is to apply Markowitz Optimal Risky Portfolios. First, we begin with the concept of diversifications. In finance, especially in investment, diversification is a strategy that makes a wide variety of investments within a portfolio in an attempt to reduce portfolio risk. There are two components of risk, systematic and unsystematic. Diversification reduces unsystematic risk. It means that unsystematic risk can be mitigated through diversifications, while systematic or market risk is generally unavoidable. In simple terms, the benefit of diversification is that the return of a diversified portfolio is simply the mean return of its constituents, while the standard deviations of a diversified portfolio is less than the mean standard deviations of its constituents. Next, we are talking about gains from diversifications. The gain from diversifying is closely related to the value of correlation coefficients. A correlation coefficient of 1 indicates a perfect positive correlation between the price of two stocks, meaning the stocks always move in the same directions by the same amount. By spreading the investment across different assets, it is less likely to have the portfolio wiped out due to one negative event impacting that single holding. Instead, the portfolio is spread across different types of assets and companies, preserving capital and increasing risk-adjusted returns. The degree of risk reduction increases as the correlation between the rates of return on two securities decrease. In addition, if the correlation coefficient is negative, risk is reduced even more. Next, measurements of portfolio risk. Portfolio variance is a statistical value that assesses the degree of dispersion of the returns of a portfolio. It is an important concept in modern investment theory. The theory that portfolio variance can be reduced by selecting securities with low or negative correlations. In concept, portfolio variance is a measure of the dispersion of returns of a portfolio. It is the aggregate of the actual returns of a given portfolio over a set period of time. It is calculated using the standard deviation of each security in the portfolio and the correlation between securities in the portfolio. For example, assume that the portfolio containing two assets, stock in company A and stock in company B. While 60% of your portfolio is invested in company A, the remaining 40% is invested in company B. The annual variance of company A stock is 20%, while the variance of company B stock is 30%. The correlation between the two assets is 2.04. To calculate the covariance of the assets, multiply the square root of the variance of company A stock by the square root of the variance of company B stock. The resulting covariance is 0.5. And then the resulting portfolio variance is 0.36 using the formula given. Diversification can also be done with multiple assets. These diversification benefits are greater the more assets we incorporate into the portfolio. With n assets, there will be a n multiple by n covariance matrix, compressing n variance terms. Let's discuss about the Markowitz Theory back to 1952. In considering a security, an investor should consider both the risk and expected return. Markowitz model is thus a theoretical framework for analysis of risk and return and their interrelationships. He used the statistical analysis for measurement of risk for selections of assets in a portfolio in an efficient manner. His framework led to the concept of efficient portfolios. Portfolio risk can be measured by variance or standard deviations of returns. Combined, this means an investor should trade off portfolio expected return against portfolio variance. It brings us to Markowitz portfolio optimization model. It applies the theory of diversification to identify the combination of optimal risk portfolio. A portfolio is efficient if no other portfolio has a higher return for the same risk, and no other portfolio has a lower risk for the same return. So, a portfolio is said to be efficient if there is no other portfolio that offers higher returns for a lower or equal amount of risk. How is the construction of an efficient portfolio? Investors are a diverse group, and each investor may prefer a different point along the efficient frontier. The efficient frontier is the set of optimal portfolios that offer the highest expected return for a defined level of risk or the lower risk for a given level of expected return. There is one optimal risky portfolio, and an investor can change their risk by combining this portfolio with the risk-free rate. The optimal risky portfolio will be the combination of securities that maximize the Sharpe ratio. The Sharpe ratio is a measure of risk-adjusted return. It describes how much excess return received for the volatility of holding a riskier asset. Please see the picture of efficient frontier. Optimal portfolio, the tangent, can be combined with risk-free to form the capital market line. It represents portfolio that optimally combine risk and return. It is a theoretical concept that represents all the portfolios that optimally combine the risk-free rate of return and the market portfolio of risky assets. Under the cap M, all investors will choose a position on the capital market line by borrowing or lending at the risk-free rate. This maximizes return for a given level of risk. However, there are problems with optimal portfolio. First, so-called optimal portfolios are static and for a specific sample. Second, it also assumes that models of risk and expected returns are valid. Third, portfolio managers can add value by identifying factors that explain returns beyond the single cap M systematic risk factor. While there is extensive literature on modern portfolio theory, accurately projecting an optimal portfolio is really a hard work. The problem is the estimates. What goes into forecasting an optimal asset allocation has a big impact on what comes out. Using only historical data for covariance and correlations can lead to large errors in portfolio optimization. Let's have a quiz for this material. Portfolio theory as described by Markowitz is most concerned with A. The elimination of systematic risk. B. The identification of unsystematic risk. C. The effect of diversification on portfolio risk. And D. Active portfolio management to enhance returns. So, this is the end of this module. See you later.